Welcome back. You're still with us on Markets Today. Well, we run through three. Let's run you through the remainder of the headlines that we're tracking for you, which brings us to the fourth headline today. A whole host of mid-cap stocks, well, they were buzzing in trade. Home First Finance had rallied close to 3% after reports suggested that some investors are looking to exit the company. Speaking to CNBC-TV18, Mr. Vishwanathan, the MD and CEO of the company, denied any such reports of Warburg Pincus exiting the company or selling any kind of stake. He adds that 20% of the shareholding by promoters is locked in till February 2024 and that the shareholding patterns may change, but there would be no exit as per what he said. Let's hear him out.
We, of course, are not privy to or party to any such discussions. And, I don't think any of the investors are looking to exit the company completely. Of course, we are a listed company, so, there may be changes in shareholding, but, what the article implies that, certain, shareholders are planning to exit the company completely. We deny that entirely. We have True North and GIC, which the combined holding is about 33%. And we have Warburg Pincus, which holds about 29% in the company. And so amongst these four investors, we have True North and Aether, that is GIC. They are the promoters of the company, as classified in SEBI. So these two entities have a certain portion of their shares locked in. So 20% out of the 33 is locked in. So only the balance 13% is available at this point of time. So as per the SEBI norms, for listing, the 20% shareholding is locked in till February of 2024.
Meanwhile, CEAT was the stock of the day. It hit a fresh 52-week high and rallied a whopping 20% on the back of upbeat commentary from the management at its investor meet. The company expects the near-term volumes to be driven by strong demand in the OEM segment. Sonal Bothra is with us to fill us in with more on that. Sonal?
Thanks a lot for that. Well, there were some positive takeaways from the CEAT's investor takeaways, and they say that demand in the near term is going to be really strong, and near-term volumes will be driven by strong demand, especially in their original equipment segment. Exports, however, they think will remain subdued in the near term. However, growth will be driven by exports in the longer term. The near-term issues is something that could impact growth there. Rural demand is relatively weak across the replacement and the original equipment segments, both of them, and it is the European demand which is witnessing some headwinds, and dealers are not stocking up because of that. They speak about commodity prices as well, which have increased around 2 to 3% on a sequential basis. But despite that, they expect margins to remain stable on a quarter-on-quarter basis, and that is, of course, the biggest takeaway there. CEAT aims to go back to 10 to 12% margins versus 6% margins that they reported in Q1. So a big margin push is something which is exciting the stock today as well. FY23 capex around 900 crore rupees, 500 to 600 crore rupees in the second half of this fiscal is what they expect, and by FY26 they expect to gain leadership in 2 to 3 wheeler segment and also achieve leadership in passenger car radials. On the back of this, Nomura thinks that EBITDA margins will improve from 6% in first quarter to 10% by FY24 and 25. They have a neutral rating with a target price of 1,273 rupees per share. Along with this, the other tire stocks also doing well in trade today.
Thanks for that, Sonal. Well, KEC International jumped in trade after backing orders worth more than 1,100 crores. The stock ended up with a gain of close to 3%. Mr. Vimal Kejriwal, the MD and CEO of the company, spoke to CNBC TV18 earlier today about the business outlook going forward. Here's what he had to say.
So as far as Brazil is concerned, all our legacy projects will get over by October or max, let's say 15 November or so. So Q2 and maximum Q3 would be the last quarter where we would see a negative impact from Brazil coming in. So Q4 onwards, I think we have a good book in Brazil on supplies. So it will start turning positive from that.
Well, the fifth headline today, Gland Pharma was down close to 2% on concerns surrounding its parent Fosun, in which reports indicate the Chinese regulators have asked banks and firms to check the company's financial exposure. Ekta joins us to run us through with more on that.
Thanks for that. Well, yes, Gland Pharma at current reckoning has underperformed this week, as well as lost over 40% of its market cap from its 52-week high. Now, there are concerns which are rising on the parent Fosun. Foreign media reports indicate that regulators in China have asked banks, firms to check the financial exposure to Fosun. However, the CFO of Fosun, as per these global media reports, has indicated that these particular reports which have come up are completely false. However, all of this speculation has risen after Fosun was downgraded by Moody's in the month of August by 1 notch to B1. There were concerns with regards to liquidity, refinancing pressure, exposure to the Chinese property market, which were brought up. Now, remember that Fosun is a conglomerate. It holds stake in various businesses, which includes insurance, hospitals, diagnostics, fashion, entertainment, and it holds around 57.87% stake in Gland. Now, Fosun had brought majority stake in Gland, 74%, in a deal valued over 6,000 odd crores, almost 7,000 crores in 2017. It was eventually listed in 2020. Now, Gland, however, has concerns of its own, which includes weak numbers. If you look at the Q1 numbers, revenue was down 26%, margins came in at around 31%, profit was down 25%. There are supply challenges which the street fears will continue for the company. The company, however, says they are confident in terms of improving growth. There have been issues such as syringe issue supplies, which now seem to have probably eased, and we've probably seen the worst of it. In terms of valuations for Gland, at FY23, the P is 22 times versus 1 year high of 60 times, and 24 is 27 times versus 1 year high of close to 50 times.
Explains why the stock was down close to 2% in trade today. Thanks for that, Ekta. Well, moving to a CNBC-TV18 exclusive. Insurance company LIC is considering setting up its own depository for insurance dematerialization. This comes after the IRDAI released a mandate for insurance policies to be stored in a demat form. Well, Yash has been on top of this. He is joining in to fill us in with more details. Well, Yash, it clearly appears that it's a benefit for LIC, don't you think?
Well, that's correct, Nigel. So last entire week, we did speak about what dematerialization means, how it benefits the depositories like NSDL, CDSL, Carvi, CAMS. And this is the exact opportunity which the largest life insurance company, LIC, also sees and acknowledges. That's the reason why our sources tell us that LIC is also considering setting up its own depository, which would be for the purpose of dematerialization of insurance policies. We've been told by our sources that the committee at LIC, a team, has already been given the task of forming a white paper which will be submitted with the insurance regulator IRDAI, which will be a proposal to get an approval for setting up LIC's own depository. Now, as far as the depository and the timeline is concerned, the regulators very clearly said that by December 2022, all policies will have to be issued in demat form, and 1 year after that, that is by December 2023, old policies will have to be brought on demat platform. Now, that's the kind of timeline which LIC is also looking at to bring together and operationalize its own depository. Why is it important for a company like LIC? There are 4 important reasons. One is, if LIC does it, an estimation is that it would be spending around 1,200 to 1,400 crore on dematerialization, which it would be paying to an outside depository. Now, with its own captive depository, it can actually pay that money to its own depository, which is essentially the money which comes to its own subsidiary. Second thing, because it's its own captive depository, the cost could also come down. Third thing, it will keep its data in its own subsidiary. And the fourth one, there's a chance that other insurance companies, at least the PSU ones, could also look at dematerializing their policies with LIC. So that's a small additional revenue which could come in for LIC. And all these reasons is why the Life Insurance Corporation of India is looking at setting up its own depository.
Makes sense. Thanks for that, Yash, and you've been on top of that one. But on that note, we've completely run out of time on this edition of Markets Today. Thanks so much for watching.